is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Welcome back to another episode of DeFi Decoded. My name is Andrew Young, and unfortunately, we do not have Alex with us this week, but I couldn't have picked a better week for Alex to be on his vacation because we have an incredible guest that I'm really excited to have on this week, which is Nick White, who is the co-founder and now vice president of Celestia Labs. For those of you who don't know, Celestia is one of the coolest projects in the crypto space. It's a modular data availability network that securely scales with the number of users, making it easy for anyone to launch their own blockchain. My company, SX, we're actually looking into deploying using Celestia. So I'm very familiar with the technology and really excited to dive in deeper and learn more. And Celestia essentially enables this next generation of scalable blockchain architectures, what they call sort of modular blockchains. So really excited. And we're also going to hear about Nick's views on the markets as well as just the crypto space in general. So welcome to the show, Nick.
Andrew, thanks for having me. Definitely missing Alex. Give him a shout out because when I was getting into crypto, I read the book that I think he co-authored with his dad. And that was one of my, first introductions to blockchain and crypto in general. So it's kind of coming full circle to be on this podcast.
Yeah, you and me both. I also read his book as I was getting into the space. Just really quick before we sort of dive into Celestia, do you want to just kind of run us through that journey that kind of got you into the world of crypto?
Absolutely. So I studied AI and electrical engineering at Stanford, got a bachelor and master's degree. And then I got into the AI industry around 2017 after I graduated, and very quickly kind of discovered that AI was this industry that was very hard to be an entrepreneur in. I always kind of wanted to be an entrepreneur. And I was simultaneously kind of looking around at different technologies, and all of a sudden, like blockchain was something I'd never heard of before. I'd heard of Bitcoin, and it just really caught my interest because it was something completely new. And I felt as soon as I understood the idea of Bitcoin and then Ethereum, I realized that it was this massive innovation, like on the scale of inventing written law for the first time, like a total upgrade, not only to like the financial system, but even just the ability for humans to coordinate as a species. And I felt that, it would be a very, very like noble cause to dedicate my life to trying to build blockchains in a way that we could actually, deliver on that promise. Because, and that kind of leads to why I'm working on Celestia, which is that the challenge that blockchain has faced so far, or one of the big ones that was still kind of unresolved, is building blockchains in a way that actually can scale to the level of the internet and to like all of humanity. Because these blockchain networks, as useful as they are, have historically been very, very like limited in terms of how many transactions they can process, and also what kind of you can think of them as decentralized computers, and they've been kind of limited historically in the kind of programs and computing that you can do on them. And so Celestia is really about solving those two problems at the same time. One is scaling decentralized compute, and then also making decentralized compute even more expressive and flexible, so we can actually, make Web3 a reality and not just like an idea and a concept.
Yeah, that's really well put. I think it's also drives really well with what we've been talking a lot about on this podcast, because like we sort of like the way we always frame it to kind of like our TradFi audience is Ethereum was kind of like smart contracts 1.0, all about security. Sort of we're in the second phase now where it was kind of like all about scalability, and we're moving into this like third era where it's still scalability is still incredibly important, but also we want to have blockchains and sort of infrastructure that's specifically designed for actual use cases. And to me, Celestia is like the missing piece, because it allows people to essentially deploy this like third generation of blockchain infrastructure. Some people call them app chains. I mean, you can call it a number of different things, but it's sort of that missing piece that allows you to actually bring highly scalable infrastructure, but to actually solve real consumer use cases. Can you just talk a little bit more about like how, like for people who don't know what like a modular blockchain means, can we just start there? And then also would love to hear sort of how you would describe what data availability means. Because I think our audience is sort of, and maybe just audience general in crypto, to a lot of people, those are still kind of, somewhat new concepts, and they don't totally understand how that actually works.
Sure. And I really like what you were just talking about. So I'm going to riff off of that to kind of connect to modularity. But, you were describing how Ethereum, they introduced this idea of a smart contract. And that was the first time that I think people kind of realized that blockchains were a new computing paradigm. Like you could program them and you could run programs on chain. And so, I like to think of, the most user-friendly or like layman-friendly term to describe what a blockchain is a decentralized computer. And within that sort of analogy, Celestia is a decentralized compute provider. And that's different than being a smart contract-based blockchain. So Celestia does not have any smart contracts. It provides like, you could think of it as like, almost like a cloud, the equivalent of a cloud provider for blockchains for Web3, so that you can run your own application-specific chain. Like you're not just writing a smart contract that runs on someone else's computer. You get to basically run your own virtual version of a computer. And that's a really powerful paradigm that actually maps very well to the way that the internet and web applications have evolved from, shared web hosting to now cloud computing, where you're not just hosting your website on, some of the like, what were some of the names of these like shared hosting providers, GeoCities and things like that. It's like AWS, like Celestia, you can think of it as like Amazon Web Services for blockchains. And I think that connects to modularity in the sense that what's the difference between, let's say, Ethereum or Solana and Celestia? The core difference is, as I said, Celestia doesn't have any smart contracts. There's not even a computing, like what we call like a virtual machine embedded in Celestia. And at first that sounds kind of like, pointless. It's like, well, then what is the point of this blockchain if it doesn't do anything? And that's where, and the reason that's modular is you're basically removing what in like technical terms is, we call it the execution layer of the blockchain. You're completely removing that from the layer one, meaning like the underlying infrastructure protocol. And now you have this very simple and very scalable L1 that can provide decentralized compute at scale and in a very verifiable, scalable way. And then people can deploy these things called rollups, which are they're like a virtual blockchain on top of it. And they can define all of the execution logic themselves. So it gives developers like superpowers compared to building a smart contract where you're forced within the paradigm that the L1 has already defined for you out of the box. It's sort of like, let's say you got a computer and it already had Windows installed. That limits the kinds of apps that you can run on it. And so you run into issues as a developer. If you want to do something new, you're stuck in this box. And in Celestia, there is no box. It's as flexible as possible. It's as flexible as building your own blockchain from scratch. And so you can control things like sequencing. You can control things like the execution environment, how the fees work, how the transactions are formatted, and the cryptography for signing transactions. You can customize things like the RPC and way that you can interact and request data from the chain. So like this whole design paradigm opens up to you when you take this approach. And that's the future, kind of what you were saying. You're you're seeing this because you're building a chain yourself. That this is the future of how blockchain-based applications are going to be built. Like, I think we're kind of graduating from this old paradigm of smart contracts to this application-specific blockchain architecture that will be more scalable and just way more powerful.
Totally. Yeah, I think for us, for example, like I think a lot of people sort of assume like, hey, like blockchains are super scalable now. Like, why do you need even more scaling than currently exists? And the biggest use case by far, just in crypto right now, is central limit order books and like spot crypto trading. And there's not really any on-chain clubs yet that have really have gone on scale. I mean, I guess Hyperliquid is sort of like L1, I guess, and obviously it's like the best performing crypto app at the moment. So I think like that, to me, that's like what's so exciting about Celestia is that it's essentially, it allows you as a developer to at least for our specific use case, like launch an on-chain club, which is like a huge use case. And I think there's probably, I mean, you probably know more than I do. Like, what are the other use cases that are sort of enabled by having this level of, scaling available to developers?
Yeah, I can. Let me talk a little bit about. So again, like the two things that Celestia provides. One is just massive scale. So to put some numbers to this, we currently have a 1.3 megabytes per second of throughput, and that equates to roughly like 10K TPS. But we have an upcoming upgrade over the next couple months that will boost that 20x. So we will be able to handle throughput up to like 200,000 TPS. And then there's been so many like throughput claims over the years that kind of dilutes it, but like this is real, like raw throughput. And so Celestia is and that's already, I think, probably several orders of magnitude more throughput than what Solana is doing today. And so that's one thing, but there's also the customization part that Celestia unlocks, which is like, now you can build really powerful new kinds of apps. So like you mentioned clubs, right? You're building a club, and if you try to build a club as a smart contract on a shared L1, you are limited in a lot of different ways. And I'll kind of list some of them out. And Hyperliquid is a great example of how you can take advantage of building your own chain from scratch to make your application better. So first is you're limited on how you order transactions, because the ordering of transactions gets delegated to that L1. And that matters a lot for an exchange, because the order of transactions determines like which trades actually hit and which ones don't. And so there becomes a lot of MEV there, so a lot of value. There's also this problem of toxic flow, which Hyperliquid solved by adding this custom ordering logic where cancel orders get prioritized. So those get executed first. They're sequenced first. So if I'm a market maker and there's some HFT guy trying to, make money off of my, sort of like maker orders that are stale, I can actually remove them before he can hit them and arb my positions. So that's a massive one. The other one that's really important is you're also stuck with the economics of that L1. So now anytime anyone wants to place an order, they're going to have to pay a gas fee to the L1. But what if, you want to do a different economic model? People are used to, when they're using an exchange, just paying, like it is free to place orders, right? But they pay the exchange fee. And that's another thing that you can customize when you actually build your own application specific, like exchange, is you can be like, the gas is totally free, but we will charge you based on the volume that you trade. So there's a lot of stuff like that. So collabs is a really big use case. And again, another reason, like it kind of also translates to the scale part, where collabs are extremely data hungry. Like the amount of like transactions that need to be processed, like if you're doing, a lot of these collabs are now pushing 5 millisecond latencies. And so every 5 milliseconds, you have all these trades being executed and all these positions being updated. And that ends up being a massive, massive amount of TPS. And so that's why like this 200K number, it sounds kind of silly based on like what we see today. But if more and more clouds launch, more and more finance moves on chain, like that throughput is actually not even going to be nearly enough. And some of the other, I mean, there's a lot of other use cases we can talk about here, but I do think the exchanges and financial applications are going to be the first to really, I think, go big on Celestia. But, you know, there's some other teams that we're talking to. For example, there's an application called Pay, Payy. They're going to announce something this week. So by the time this comes out, people might have already seen it. But it's basically a private stablecoin payment app. And what's really beautiful about it is it's a very consumer-focused app. And they took advantage of application-specific things to make it as powerful as it is. So first of all, the privacy, right? If you're going to use a consumer stablecoin payment platform, you don't want to have your entire balance and your financial history revealed every time you buy your coffee, or if you Venmo your friends, you just want to pay your friend back for dinner. You don't want to just like have them be able to see literally how much money you have and everything else you've done in the last like year. And so they built in privacy by basically creating their own custom execution engine that models after Zcash, which is a privacy, like a ZK powered privacy chain. And they also did a lot of really interesting things on the cryptography side to make their wallet user experience extremely seamless. So they have custom cryptography and transaction formatting that makes it so you can actually use your secure enclave on your phone, sign transactions with Face ID. Your private key is backed up and embedded naturally in things like iCloud. So like you download the wallet and you download that app and you don't even know that you're using a blockchain because it just feels like a Web2 app. But they couldn't have done that if they built it on Ethereum or Solana. They couldn't have done that. They'd be stuck within the wallet paradigms and they wouldn't be able to build privacy, right? So it's these kind of, that's just like a really good example of like how this unlocks new use cases that I think will lead to dramatically better applications and more adoption for blockchain. Yeah,
that's really cool. I'm gonna have to check them out. I think, just on what you're talking about in the on-chain clubs, like it's as reference for SX, which is like a sports prediction market. We typically, the amount of, it's typically a 1,000 to 1 ratio of like actions on the order book to actual trades. Like there could be a couple thousand trades per day, but there'll be 3 million order book actions in terms of like posts, cancels, and things like that. And that will just continue to scale. So that's why 3 million transactions per day would be cost prohibitive for any other L1 or L2. I guess maybe some of the new ones, kind of like Eclipse, potentially you could do it, but it does get and that's for example why we built a rollup. And so totally agree on everything you're saying there. I think one of the things I do want to also talk about is you guys are very I would say you guys are kind of famous for prioritizing growth over everything else. And I think like the numbers kind of bear it out. Like you guys have grown tremendously in the last 12, 24 months, really. And the timing was also perfect in terms of just, the rise of roll-ups and L2s. But I want to sort of get your opinion on this like shift in narrative in the last kind of 6 months, where people are kind of really focused on revenue right now. And you put out a great tweet I think like a week ago, talking about how like growth is more important. And it's something I've kind of talked about a lot too. Just, I think at least for use cases where network effects are really important, like growth is obviously more important than monetization, at least early on. So yeah, just curious if you want to kind of expand on those thoughts, on your tweet, kind of talking about how growth is more important than revenue. Just kind of if you have anything else to add on top.
Yeah, I'm glad you brought this up because it's a pretty common misconception, I think, when people learn about Celestia. And essentially what it is that if you look at the raw numbers of like revenue, the Celestia protocol does not make very much money at the moment. And that's for a variety of reasons. One is the price. So what does Celestia produce? It produces this like decentralized compute as a resource for folks like you to build these decentralized apps and run your own decentralized computer at scale. And we're intentionally pricing the decentralized compute very cheaply right now because we want to make it very easy and cheap for people to experiment with this like net new product and resource. And we also want to like grow as fast as possible and eat up as much market share as possible because this being the go-to decentralized compute provider for Web3, we think is going to be a very strong sort of like network effects business where, the more market share we have, the more valuable the platform will be in the future. And so foregoing a certain amount of revenue now makes total sense because it will more than, pay us back in the future. And so we're just not, a lot of people I think are a little bit short-sightedly overly focused on revenue today versus thinking about how much revenue can a protocol make, 5 years from now, right? And I think we take a lot of, we compare ourselves a lot to compute platforms like cloud compute platforms like AWS. And, Jeff Bezos is very famous for Amazon running at a loss for like decades, before they started and they were reinvesting all of that back into growth. And it paid off because they built a network effects business, not just on the retail, like the e-commerce side, which most people are familiar with, but on the AWS side, which is 60% of their revenues, 60% of their profits. Like if AWS was his own company, it would be worth $1.5 trillion, which I find mind blowing. And anyway, so I think that strategy has played out very well for other similar businesses in the past. And so like, we're not innovating or doing anything crazy. Like this is actually kind of like a well-known playbook. And so far it is working. Like the demand for using Celestia has been growing roughly at like a 10% week over week pace for the past, I don't know, I guess kind of since the beginning of the year. So we're seeing a lot of growth, and the thesis is playing out extremely well. Like more and more people are choosing to build in this new paradigm, and they need a scalable sort of decentralized compute provider like Celestia. Like it's not just, folks like yourself that are building something new. It's pre-existing enterprises, whether those are crypto companies, crypto exchanges, or TradFi companies that are like Robinhood, for example, that are getting into crypto. They're all launching. They're not building smart contracts. They're all launching their own chains. So Celestia is just very well positioned, and we see this as a moment in time to like grow and eat up as much market share as possible.
And yeah, can you just talk a little bit about like the pricing dynamics of data availability? I think this is probably like the most misunderstood aspect when people sort of look at Celestia or just like the TIA token to invest in. Like how does how does scale over time lower the cost for everyone? I guess I understand like you guys have built essentially a chain that's fully specialized on providing like what you call decentralized compute. And, it makes sense that like, as you guys grow, the platform will become more and more decentralized. And that's also a really big, value for like L2 developers like myself. But I think also for, maybe this is just me, but I think a lot of other developers probably have the same thing, which is cost is incredibly important. So, yeah, do you want to just talk a little bit about like how, as the network scales, how does that sort of bring down costs for everyone? While still, allowing you guys to sustainably operate long term.
Yeah. So you're right to point out that the other side of this equation that I wasn't talking about is like the scale and like the how much demand we think there will be in the future for decentralized compute. And if you sort of forecast into the future, like, not just these exchanges and financial applications, but a lot of the other more sort of like far out, but I think very plausible and like inevitable use cases like decentralized social media, non-fungible tokens, and that whole sort of like more art realm, things like the metaverse, which I truly do think will work in the future. Things like AI, like agents and bots. Basically, I think that blockchains will be sort of the substrate through which they interact with the real world via payments and things like that. So if you forecast all that out, like the amount of potential demand for decentralized compute is like absolutely silly. And so that's a big component of like, you can still, like Celestia can charge a very, very low fee, but when there are when there's enough demand, like that becomes a very like profitable, high revenue sort of like business to be in. And so, yeah, like, whereas if you're, and so I think to kind of get to your point, like when you're operating an L1, like there is sort of like a fixed cost of like, there's this many validators, there's, this much bandwidth that all those validators need to consume and things like that. And so you need to overcome at least those fixed costs in order for this whole thing to be economically sustainable. And if the amount of sort of like decentralized compute you can provide is only this big, then you need to charge a higher per unit price, essentially, to overcome those costs. Whereas in Celestia, we can have the same, like roughly the same fixed costs, but provide dramatically more of this decentralized compute, and for the same cost, and therefore we can at a per unit price charge a lot less and still be generate as much profit, essentially, as a protocol. So it is sort of kind of what you're pointing out, which is like, by the economies of scale, that allows everything to be cheaper. And again, that allows, there's this whole concept of induced demand. Like when you make things cheaper, we've seen this with computers and so many other markets. When you make things cheaper, it actually counterintuitively increases demand in a way that ultimately can often make the overall market larger. And so like that's sort of where Celestia is hoping that we can take decentralized compute, is make it so cheap that you just start to run even more things you would never have thought of on chain.
Yeah, that makes sense. That's really cool. I mean, I think like that, to me, that's like the aspect of Celestia that's really exciting, because I think we touched on, like, as you guys grow, you'll get more and more decentralized, like there'll be more and more validators. So like the decentralization aspect makes complete sense to me in terms of like the network effects of, as protocols grow, they almost inherently become more and more decentralized. But the fact that you can actually drive lower and lower cost as you go, but then still be economically sustainable as a network, I think that's like the really really sort of exciting aspect, at least from like kind of like an investor standpoint. But very cool. Okay, sort of moving to some other aspects, like what do you kind of we sort of framed up the discussion at the start of like there's like these three eras of sort of smart contract development, right? Ethereum, all about security. Sort of era number 2, which is Solana, Polygon, whatever. Kind of a lot of the sort of newer entrants last cycle was all about scalability and sort of less so on decentralization and security, at least from like a maximalist perspective. And then like now, I would say like we're very much in the sort of beginning phases of this third era, where more and more sort of custom designed rollups. We saw Robinhood announce their L2 last month. Coinbase obviously has one. Kraken is launching Inc. soon. What do you think? Like, what do you think the next kind of 3 to 5 years looks like? I guess what comes after modularity, or is modularity like sort of the final and stating we're just going to see an explosion in kind of like new ecosystems designed for specific use cases.
I do think that modularity is the end game. I mean, barring some other kind of new innovation, it from an architectural standpoint is pretty optimal for a lot of different reasons. One is, as a developer, you get all this extra control and customizability. You get even more scalability by having a dedicated chain for your application. But you also don't have to do all the overhead of launching your own chain. So it's like this amazing sweet spot of I have all the benefits and, none of the downsides, essentially. Now, the caveat I'll say, and this is, I think, what's going to be important to watch over the next 3 to 5 years, is that launching your own chain still comes at some costs. And specifically, one of the challenges is interoperability between these different chains and onboarding users. Now, these things are improving really, really quickly, and even from a year ago are dramatically better. But there's the idea of fragmentation, which is, well, when you build on a shared computer like Ethereum or Solana, there are already a number of people there with money on a wallet that can immediately interact with your application. And there's no extra overhead for them. They just pull up, your application on their browser or on their phone, and they can just quickly, place a trade or buy the NFT, et cetera. And when you have your own chain, the reality is currently you need to oftentimes bridge funds into that chain, which is like a user hurdle. They may have to set up a new wallet as well to interact with your chain. And so the composability aspect becomes a bit of a friction. What's exciting that's happening to me is that there are better and better wallets and better onboarding experiences and better interop solutions that are increasingly making this whole process extremely seamless, such that you won't have this trade-off. I think of it as the cost may be this much today, and then over the next 5 years is slowly going to, not slowly, but going to trail down to basically zero. And so I think that's one thing to watch. Now, the interesting thing too is that despite those costs, for a lot of the most important use cases, it really doesn't matter. That matters most to a new team who does not have traction, they don't have distribution, they don't have users, and they're going to want to build on something like a Solana where they can quickly attract users more easily. But if you're a base, if you're a Robinhood, if you're a Kraken, et cetera, or any a bank, et cetera, you don't really care about that because you already do have users, you already have liquidity that you can immediately just bring on chain, and it's not any more friction. You're not losing out on this advantage of distribution. So I think we're going to continue to see, despite that, a lot of the biggest players still building their own chains, their own rollups, because for them the cost is not that high. And I'd also say that we're seeing a pattern as well, that even the successful apps that start out on an Ethereum or Solana L1 eventually migrate to their own chain. So I think of these Ethereum or Solana as these launch pads actually for applications. As you start out with your MVP and your V1, you grow your application there. But as soon as you hit any kind of meaningful scale, you're going to want to transition to a rollup so that you can improve the product, you can capture more value, and you at that point you already have your distribution. So it makes sense to sort of break away. If I was a poly market, I already have the distribution. Uniswap is doing their own chains because they already had a bunch of users. Hyperliquid has already also shown that even for something like trading, where you'd think might have been a big hurdle for people to onboard liquidity to their exchange, it really wasn't a barrier for them to be as successful as they are today.
That's really cool. So that's actually really interesting. So the next wave, or not even really, I guess, extension is sort of this interoperability, almost like cross-chain. Like users will be able to use any app, or at least be able to transition seamlessly across chains. And then just on what you're talking about on the app chain, totally agree. I mean, that's actually how we started. We started on Ethereum, then we moved to Polygon, sort of built up a user base, and then ran into some issues. And so we decided to build out our own infrastructure using Arbitrum Orbit. So yeah, I think that, like, to me, that makes complete sense. I think at the time that was seen as like a lot more risky, whereas I think now with like Hyperliquid and like what you talked about in terms of Robinhood and Base, just, you know, launching straight with the L2, it makes complete sense. Like it's almost, I would say it's been a pretty radical shift in the last 2 years from people saying like, oh, you're going to fragment liquidity. Like, doesn't make sense. Let's, you know, like kind of like, let's just have one blockchain and everyone use that, to now it's almost like consensus that it's going to be, you know, it's going to be fragmenting into all these different chains.
Yeah. And the interesting thing is that, I mean, I hear this from builders all the time that we talk to, but I don't think that the broader narrative has like caught up yet. Like people are still kind of stuck mentally. Their mental model is still in the old era of like, oh, L2s are broken and they suck. But that's always how it is. Builders are always like, you know, a year or so ahead of like where the narrative like always follows afterwards. So it'll be interesting to see how the awareness of that will actually like penetrate more broadly into the market.
Yeah, that's interesting. I guess I didn't realize that. Just obviously, you know, being on the builder side entirely. How one thing I do want also. So I think like first of all, that should be great for Ethereum. I think like as because Ethereum's obviously has decided to the opposite of essentially Solana in terms of like how they see scaling long term, which then obviously should be really good for you guys as well. And so, yeah, that's interesting. That's interesting to think about that. That's like the coming shift. How do you guys think about like one of the other sort of criticisms of Celestia, maybe less so nowadays, but in the last kind of year or 2 years was that you guys are taking DA away from Ethereum. I think like for me who works in the space, like it's not practical to use Ethereum for DA, but like the alternative is something like, you know, our antitrust or like Arbitrum solution or something like that. But do you want to just talk a little bit about how you guys see whether you're, you know, complementary, competitive with Ethereum just more generally?
Yeah, absolutely. So, you know, Celestia is an L1, just like Ethereum and Solana. So in a sense, there is a degree of competition of like trying to go after a similar place in the stack, right? And I think of Web3 stack as like the L1s being like the security layer of these applications. In a sense, you know, where Ethereum is coming out of it is like they started out as this sort of, you know, more monolithic like architecture of like a, you know, a full like computer with a VM and all this state and smart contracts and things like that. And then now they're trying to transition to something that's more modular and has data availability, like just raw decentralized compute alongside of this like sort of full stack computer. And Celestia is coming at it from the angle of just totally rebuilding everything from scratch to be optimal for this future. And so I think that's a massive advantage that Celestia has in the long run, is being a platform that has been designed from the ground up with the benefit of the knowledge of like, this is how this is what the end game of blockchain architectures is going to look like. So that's a pretty big advantage, I think. Now, what Ethereum does have, and I don't really think of Celestia and Ethereum as competitive, you know, in like it's not, at least it's not something that we think about internally. But Ethereum does have is they have this built up sort of state and value and community from the original L1, and that makes the data availability, like the decentralized compute alongside it, differentiated and slightly more valuable from the sense of these L1s are these like kind of, I call them security zones. And so if you're a roll-up developer and you want to really have a secure way to interact with the stuff that's happening on the Ethereum L1, whether that's DeFi or RWAs or what have you, you are going to be willing to pay a premium to post your data, to post, so sort of like run your rollup on Ethereum's decentralized compute versus Celestia's. Because if you run it on Celestia's, there are more trust assumptions when you're trying to interact with Ethereum. And so, but on the flip side, Celestia is significantly cheaper and will continue to be cheaper. And not only cheaper, but also like orders of magnitude more scalable. I think that right now we have roughly 50x of Ethereum's throughput. And after this next upgrade, it'll be like obviously like 1000x, right? I mean, Ethereum is also scaling, but the way that we see this market evolving is the demand is going to go exponential, and so we're always trying to be way ahead of the curve, and not only cheaper today, but also able to withstand orders of magnitude more demand of decentralized compute without having to without having to hit congestion. And I think like Ethereum, unfortunately, is a little bit behind the curve in terms of scaling. And so we end up seeing a lot of like the more throughput sensitive, cost sensitive applications are building on Celestia for that reason. And then the applications that really care about connecting deeply and integrating with the Ethereum ecosystem as it is, going with Ethereum for now. So that's kind of the way that I see it.
Yeah, I totally agree. I think that makes sense. And yeah, I think I kind of view Ethereum the same way. I think it's like it provides security as a service in a way. But I suspect like for the most part, people are going to be using sort of custom DA networks like you guys, just because it's like far more cost effective, I guess.
Yeah.
Okay, we don't have too much more time, so I do really want to get your predictions on just the crypto space in general. Just over the next kind of like second half of the year to maybe the first half of next year, next 12 months. Do you have any kind of specific predictions on crypto? How are you feeling? I mean, I feel like a lot of the people we've been talking to on the investment side are bullish in the short term, but maybe a little bit wary long term, just given kind of like the market cycle. How are you thinking about sort of the crypto space just in the short term for the next 6 to 12 months?
Yeah, I will caveat everything by saying like I'm inherently just focused super long term and inherently very bullishly biased and optimistic because I think about like 5 years from now, right? And like to me, everything that the amount that the space has grown over the past 5 years is pretty dramatic, and how especially now with all the regulation that's coming out and the way that traditional financial institutions are like racing to get into the space and sort of like build natively on chain is like extraordinary. I think we all knew this was coming, but like this is the moment where it's like finally happening. And so over the next 5 years, I just see the demand for running things on chain, like decentralized compute, like going exponential. And so like that's what I'm really focused on. Like in terms of like the market itself over the next 6 to 12 months. I don't know. It does feel like everything's been, even though Bitcoin has been going up a lot, the broader sort of understanding of like blockchain is not just about making a currency and a store of value, which is a huge major use case and a huge accomplishment that Bitcoin is as recognized as it is today. But blockchains are a lot more than just Bitcoin and just alternative currencies. Blockchains are decentralized computers, and they're going to be like a development like paradigm that I think levels up the internet to do many things that people are not really even like thinking about or aware of. And I think that's when I think people will start to take more interest in other platforms like Ethereum, Solana, or Celestia, for example. And so to me, it's only a matter of time before people like the interest in Bitcoin kind of trickles down into people realizing like, oh crap, there's a lot more even cooler things happening here. And what's interesting too is like I was talking to my uncle at a wedding last weekend, and he understands Bitcoin, but he's like, I don't want to hold digital gold. He likes to own productive assets, right? And what's interesting about crypto, like I guess currencies like Ethereum, Solana, Celestia, et cetera, that are decentralized compute platforms, is that they're a lot more like equity. They're like a cash flow producing, asset that, I think that opens up a whole nother class of investors that might not really resonate with something like Bitcoin, right? And equities are just an absolutely massive market. So I think that's going to be interesting to see if there's more kind of awareness that trickles down that way. So I don't know. I also feel like the market's been extremely risk off and interest rates are really high. And so anything that gets people more comfortable with being more risk on is going to really be helpful for crypto markets. And that it feels like that's a possibility over the next 6 to 12 months. Yeah,
totally. I know we don't have too much time. I do want to get your super long-term predictions. I think one of the things that I'm really bullish on as well is I think one of the issues plaguing a lot of the crypto market beyond kind of just Bitcoin, Ethereum, and Solana is very unclear tokenomics models. You know what I mean? People are very bearish on, you got this application and then you just got this, maybe you have a smart contract protocol and then you have this governance token. And to me, the tokenomics model that makes the most sense is a blockchain with a gas token and essentially the token controls the ledger. And so that's also partly why I'm very bullish on roll-ups and things like that, because it's a way to essentially turn beyond just turning applications into their own chains, which you talked about has a lot of defensibility benefits and customization benefits. It also has the other effect of cleaning up the tokenomics of a lot of these projects, because it inherently sort of transitions projects from a quote unquote useless governance token to an actual an app chain token, which I think everyone sort of understands. So I think that's one.
I think that one of the consequences of if we really solve fragmentation is that there won't really be a need to build on someone else's chain for distribution. And that's even, would apply to things like Base with Coinbase, where I think a lot of people are choosing to build on Base because Coinbase has a massive amount of distribution through their centralized exchange. And now they're sort of expanding that on chain via their L2. But I think that more and more people will just go straight to the launching their own chain thing. And it will be, for that reason, their tokens, if there's a token associated. Well, one of the nice things, by the way, about building this new paradigm that Celestia enables is you don't need to launch your token at all. Or even if you do, you don't have to do it right away. Whereas previously, if you wanted to build your own chain, you had to issue a token to secure the network, right? And that's really problematic because then you have all these other issues. Not only is it a huge effort for the team building it, but also you need to have already figured out your token economics, and you need to have a compelling story and all those things that are really difficult. And what's better is to either launch your application first and then later add in the token when it makes sense. Or if you're just a traditional business, you want to do things on chain, you might not even want to ever launch a token. Maybe you have just an equity business in the back end where all the cash flow and revenue is going to. So I do think you're right that we've been living in this world where we've had to conflate sort of infrastructure and application tokens together, and it's better to separate them. And Celestia is purely an infrastructure token play that provides decentralized compute for developers. And then the developers can build their own applications, and if they want to, have their own token that is tied not to infrastructure, but to the revenue that their application, let's say an exchange like what you're building, whatever revenue that creates can somehow be tied into value capture for the token. So yeah, I think this new paradigm will also clarify a lot of those issues. And We're also entering a new regulatory regime where we might have more clarity about what tokens can be and what's allowed, right? Where we've been kind of stuck in this governance thing, partially because people were scared to try to experiment with tokens because you could get sued. So I think we're going to see a lot of evolution and maturity over the next few years. Thank you, Andrew. This is a fun conversation. Looking forward to seeing you launch your exchange, and good luck.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.